The US has had 0% interest rates for 7 years now, and markets are clearly focused on when that policy changes. So we've been fueled by cheap money and low interest rates for so long that it's unknown how markets react when that does change. Emerging markets could be hit the hardest by that, with capital outflows and currency impacts. China's slowdown is clearly pronounced, and we've seen that by very sharp falls in commodity prices. But that being said, China's got a lot of tools at its hand to be able to stimulate growth, and combined with both Europe and Japan, who are both going to put more stimulus into their economies, that could be a real tailwind as we head into 2016. The mining boom is clearly over, so Australia is now looking for the next source of growth and innovation. But Australia is a very small part of the global economy, and most investors are too leveraged to Australia. They're leveraged via their jobs, their income, their house price, their investments and their super. And this is effectively a one-way bet on China and the Australian economy. And that's been a good bet in the past, but we're less convinced that that's the way to go as we look forward. And we really just need to look at what was our largest listed company, BHP, with its share price currently trading at a 10-year low. So investors need to be thinking outside of Australia to generate their return opportunities. We're in a very challenging environment where most asset classes look expensive, whether it be fixed interest, property or equities. So investors need to be very selective when they're allocating capital. We've got a lot of central bank divergences which will create opportunities for investors, but we're not so much looking at an asset class level to find those opportunities. Rather, we believe that the opportunities lie within asset classes and within investment markets. That being said, investors need to be flexible in the environment we're heading into. So we don't want to be long only and constrained to markets that are fully reliant on rising trends. Rather, we believe that investors need to be more flexible, where their opportunity set is much wider and they can benefit from both rising and falling markets. And that's where the best returns will lie going forward. Given the macro risks that we see that lie ahead, we're quite defensively positioned with our portfolios. We've removed our emerging market exposure, we've got relatively low equity market risk, and more focus on alternative assets that aren't reliant on equity markets rising to generate returns. Equity markets and property markets have been fueled by cheap money and low interest rates, and that's made valuations very expensive. So we believe that it's more prudent to focus on downside risk and preserving capital than chasing all of the upside returns. So in this type of environment, we're more focused on generating positive absolute returns over the full cycle and protecting investor capital. Most investors are far too focused on Australia, and we believe that the best opportunity set lies outside of Australia. With record low interest rates, achieving a positive return is extremely hard, and most investors are being forced out to take more risk. Understanding those risks is critical. So 2015 has been a very muted year for returns, and we believe that as we head into 2016 we could be headed for more of the same. Most investors aren't positioned for that type of environment. The absolute return type of approach that we have adopted at Morrows is the best way to invest in this current environment. We've had a very good year in 2015, and we believe that the approach that we adopt for investors, where we're clearly focused on achieving their objectives, is the way to move as we head into 2016.